Hello and welcome to Switzer. I'm Peter Switzer, and last week on switzer.com.au I wrote a story about Rastafarian economics. Don't worry, be happy was my theme. And the reason I said that is I saw a number of developments that tell me that the Aussie economy could easily rebound better than what a lot of economists had been expecting. Now I could be wrong, but the bottom line is the stuff I'm seeing coming out, even in the month of May, which was the election month, were all pretty positive. Let me run through some of the things that I think will help the Aussie economy in the second half of this year. And if it helps the economy, it's bound to help the companies that we invest in. So we've got tax cuts, they're coming. We got another rate cut, so we've had two rate cuts pretty well since the election. Retail sales rose only 0.1%, but they did rise. Sydney and Melbourne house prices rose for the first time in donkey's years. The Services Purchases Managing Index went to the highest level in 6 months. That's what purchasing managers are buying out of factories. The CBA PMI, Purchasing Managers Index, for manufacturing rose and continues to expand. Building approvals rose 0.7% in May. The trade surplus hit a record surplus. The ANZ weekly consumer confidence number rose 4%, and that's the biggest rise in a year. We got the measure of economic conditions from this ANZ survey. Now that came in at the biggest rise in 2 years. New house sales rose 28.8%. That's the highest level since 2018. Our federal budget is now around balanced, and that's a very good development, heading towards a surplus. The share of foreigners owning Australian shares is at 31.3%, and that's the highest level in 4 years. And today, Monday, ANZ job ads came in up 4.6% in June, and that's the biggest increase in 18 months. We're going to see a lot of June and July numbers this week. Business confidence, business conditions, and consumer confidence from Westpac. And I think it's going to start showing us whether this economy of ours is actually improving post-election. Now, if that's the case, the Reserve Bank Governor could easily hold back on that expected interest rate cut on the first Tuesday in November, namely Cup Day. I really hope that's the case. I also should throw in there's been a minimum wage decision, which also should help retail sales, because people who are on the minimum wage invariably spend most of their income. So that's the positive setting that I'm seeing. I hope it continues. It didn't help the stock market today, and we'll look into that in just a moment. The stock market had a shocker today, and so how come? Let's find out with Bell Direct's Julia Lee and CMC Markets' Michael McCarthy. Well guys, as I say, it wasn't a great day in the market. Julia, how come?
I guess first of all, we are seeing lighter volumes come through. It is school holidays in New South Wales. So
the kids actually invest in the stock market?
No, the parents go over to Europe or wherever it is they go on holidays to. But look, we did see an increase in geopolitical risk happening. And I think there were two factors. One, the rally behind the market has been well supported by the easy policy that we've seen in central banks around the globe. Yep. And on Friday, we saw a big release, and the non-farm payroll numbers, they blew expectations out of the water. And this is a market where good news is seen as bad news. So the probability of a 50 basis point rate cut from the US in July this month has gone down significantly. So look, that was a bit of the weakness in the markets. And then around our region, we saw an escalation in the tensions between Japan and Korea, where Japan has stopped exporting three components of technology goods to Korea. And those companies that do export those goods, they need approval by the government, which is a 90-day process. So we saw Korea in particular sold down quite heavily, down around about 2%, but Japan was also down 1%, and the Aussie share market down as well.
Well, Macca, I must admit, I loved it when I saw that great job number and saw bond yields go up. So all these people said, well, the bond market always tells you what's going to happen in the future. Well, the bond market changed its mind on one figure.
Well, it wasn't a complete turnaround, Peter, but that number did directly cut across the current market story. Yeah. And I think that's why it did so much damage in the region. When you factor in the points that Julia made, and also the fact that trade tensions continue to simmer. The White House made some very conciliatory noises over the weekend, saying that they expected there would be a face-to-face meeting meeting of negotiators very soon. However, a very influential WeChat account, the Torren Park account, stated over the weekend that the removal of existing tariffs on Chinese goods by the US was very important to the negotiations, and that looks like a sticking point. So we had plenty of reasons to doubt the market today. Now, we all know the share market goes up by the stairs and down in the lift, and it was definitely a down in the lift day today. However, as Julia pointed out, volumes were well down, 30% down on average day. So it was a bit more of a buyer's strike today than it was actually a panic sell down. And it was interesting to note the two worst performing sectors, property and utilities, not only are interest rate sensitive, but they've been the strongest performers over the first half of the year.
Yeah.
So it looked like a lot of investors who were sitting on some very strong share market gains got a little nervous, decided to take some profits, and with nobody there to catch it, the market fell more than we expected.
Yeah. And I noticed that job ads came through a 4.6% rebound straight after the election, which is interesting. And I wrote a piece on Switzer.com.au on Friday called "The Rastafarian Approach to Economics." Don't worry, be happy. And I listed 14 things that have happened lately that could make you positive about the market and might cut out the need for another interest rate cut on Cup Day. Do you think there's a possibility that the economy might be so good that we won't see a Cup Day cut?
Look, I don't think it is about the Australian economy, but at the moment, a lot of it is about the US economy. And, interest rate sensitive areas like Michael mentioned, property and utilities, you expect these sectors to go down when, you see interest rates not looking too bad and, perhaps even going up. And so because we are in a global interest rate environment and a global funding market, the fact that the market started to price in the probability of, a smaller rate cut coming through from the US or maybe even no rate cut in July had an impact on those bond proxies in the market. So that was quite interesting to see, given that we were reacting to something that's happening in the US economy.
What do you say, Mike?
Well, first of all, I strongly object to your Rastafarian title. As a fan of ska, reggae and ragga, that is a terrible misuse. But secondly, yes, I think the language we've been hearing from Philip Lowe in particular, but the RBA board generally, is that they seem to be reluctant cutters.
Yeah.
And one explanation for that could be that they think we're seeing a bit of a soft patch in growth data, but that we'll also see a rebound. Now, nobody's predicting a boom, and I don't think that's the way the RBA is thinking too, but the US markets backed off hard on Friday night. The consensus forecast analysing the interest rate markets was for 3 cuts by the end of the year. By the end of the trading session on Friday night, that was back to 2 cuts. And that sort of swing is important because if we continue to get stronger numbers, that probability will continue to diminish.
And it's an important message for investors, I think, that so much of what's happening in markets is being dictated by central banks. So that is a key thing to watch for.
Okay. Now, a nasty tweeter, who's actually a big fan, so I'm begging too much, pointed out that you once supported Challenger a few months ago?
I think 11 months ago.
Okay, 11 months.
Maybe longer than that.
Okay. We won't mention the fact it was $11 at the time, but you kind of liked it then, and you don't like it now. But last week, Macca liked it. So let's tell us how come your Challenger, rarely you make a mistake, but this was one that wasn't your greatest call.
I mean,
what
first of all,
went wrong?
I would love to be right 100% of the
Yeah,
time.
that's-
Unfortunately,
I
that
expect
is
that, by the way.
impossible. But look, Challenger, I liked it at the time for the reasons we were seeing, a shift towards the baby boomer generation, annuities or new products coming out. And, they also looked like they were doing this deal
And
with
the
the
economic outlook was
Japanese
stronger
company,
then,
so
wasn't it?
increasing market. But since then, what we've found is there's been a real structural shift towards industry super funds, and that's been a negative for Challenger. So as long as that trend continues, it looks like Challenger's business models coming under pressure despite the demographics, the need for income, and annuities being quite an attractive type of product in the market that we're in.
And the
So-
economy was stronger then, and interest rates were likely to be rising rather than falling, and that would have been better for Challenger as well.
When I invest in companies, I look for catalysts, and some of those catalysts are often new management, new strategy, new products. And with Challenger, it was really the new product side of things, which got me excited. But the structural shift that we are seeing towards industry super funds here in Australia is quite a big one, and unfortunately, it's been a bit of a negative.
So why do you like it, Macca?
It's about the product. Well, first of all, what hasn't changed about Challenger from 11 months ago to today is its top quality management. This is a crack team. And that's a sort of management team.
Brian left, hasn't he? He was the old CEO.
There have been changes, but this is not platinum, right? This is not a single person event. They've got quality across the board.
Right.
So I always look for that. When a share price of a quality company comes under pressure, it's worth a look. For me, it's about those annuity products. Whether or not we see growth come back, it's clear we're in a lower interest rate environment than we're expecting, with cash rates at 1%, the 10-year bond rate in Australia at a record low of 1.25%. Investors are being forced into the market, and an alternative for them is the capital stable annuity style product that Challenger has led the market in. So I expect to see a swing back towards that product, notwithstanding other industry trends. And that's why I think at current levels,
I must admit, I thought Challenger had an opportunity because a lot of advisors were thinking about putting some part of their client super into an annuity, basically like as a foundation, and then they would go for higher growth in some other areas, which is still a possibility.
Absolutely. Look, they do have some new products on the horizon, which should help to help their business model and hopefully revenue as well. But this is what I love. This is what makes a market. And look, prices have fallen quite significantly, and I think it really does demonstrate when I'm wrong, I don't mind being wrong, and I have my risk management in place. And what I try and do is cut my losses early, so
How long before you got a loss? 10%?
I actually made money on Challenger. Yeah, I made money on Challenger
so
and I got
sneaky.
out. Oh.
Yeah, she also had a horse that won the Lordmares Cup on Saturday at 17-1, Cup Fever, and didn't even tell us. I only learned that when she tweeted. She was so happy. And I got stuck in there on Twitter. So why didn't you tell us? She just shared tips, didn't tell us.
I was so excited. The first City Saturday race meet that won, and the only trophy ceremony. I got to hold the trophy.
Congratulations.
I never won a trophy in school. I was never a runner or a basketball player.
Wow. That is
Pretty
Okay,
excited.
that's good. All right, the stock you like going forward.
I like Eclipse at the moment. So looking for catalysts. Look, they've sold some of their non-core businesses, but in their core business, they're looking at cost cutting at the moment. And look, they'll probably sell a few more. What's important, I think, is the 30th of September, where they'll be looking at refinancing. So the covenants are going to be important.
Explain to our viewers what Eclipse does in core sense.
Fleet leasing, they're very big in terms of salary packaging. They haven't been doing so well because of their Grays business, which has been a
Grays
drag.
Online, which is
Grays
sold.
Online, which just sold. And importantly, it's sold at a capital loss, but they're not going to take that into account when they look at the covenants. So look, the refinancing in September, it looks like it could be a positive catalyst for Eclipse. And look, the shares were sold down so heavily because of the possibility of a capital raising. And look, that looks like it's off the cards now. They're selling their non-core businesses, they're looking at cost cutting, and I think we're going to continue to see a re-rating of this stock. Over the last 3 months, it's been performing pretty well.
Okay,
and I
Michael?
think it'll continue.
Two stocks I like. One of the things I look for, Peter, is stocks that go up in a down market. And today, the two top performers in the top 200 stocks were Speedcast and Costa Group. Now, full disclosure, I own Costa and I bought Speedcast today, right? So with that on the table, I'm biased. But
and both stocks have been really loved, and lately have had some shockers, haven't
absolutely had the living daylights kicked out of them, Peter. And that's why I'm attracted to them. People say there's no value in the market. Well, there
they? It's
is.
basically why
But you have to look through.
It's why your beloved went for you, because you were rejected by everybody else. Just joking, just
You
joking.
did snap me up and
No.
All right, because I paid top of the market.
But she gives up the quality price. just
Always
like you.
quality.
So what do you think of those two stocks?
Yeah, interesting, especially Speedcast. They did recently win a contract, which is good to see. But look, they look at communications for remote locations, so things like the Carnival contract, as well as mining projects, which need
Carnival
remote-
is the
the
boat.
cruise ships,
Yeah.
where you still need communication. So,
So
I
they
think-
deliver data
I
via
think-
satellite.
Yeah.
Interesting at these levels. Certainly the risk reward seems to be there, and if it turns out to be more of a timing issue and cyclical, that you do see an uptick in some of the things.
Okay.
Speedcast,
I'm
I
kicking
think,
myself I didn't buy them at
Speedcast
161 low. They're back up
looking
above
at
$1.90
180,
now.
yeah.
How high did they get last time when we all loved them?
Oh, above $6.
Yeah.
Yeah.
Okay, well that's our tips. Just hope that Julia remembers to tip us her horse when she knows it's going to win. Don't tip it when it's going to lose, all right? But that's our catch up with our two market gurus, Julia Lee from Bell Direct and Michael McCarthy from CMC Markets. Hi, I'm Peter Switzer.
And I'm Paul Rickard. And we'd like to invite you to our 2019 Switzer Listed Investment Conference.
Now, the Switzer Listed Investment Conference brings together some of Australia's best money managers. On the day, they'll tell you how they're investing both at home and abroad and give you tips on how you can maximise your investment portfolio. Tickets are only $49 and available to purchase now. Don't miss out on your opportunity to hear from Australia's best money managers by securing your spot now. For more info and to purchase tickets to the event, head to www.switzerevents.com.au. Attending will help you make well-informed financial decisions this year and maximise your portfolio. Well, each week we go looking for the best stock ideas from someone who plays the market virtually 24/7. This week it's Morgan's Raymond Chan. Thanks for joining us on the program, Ray.
Thanks, Peter. It's good to see you.
Yeah, same here, mate. Now, look, I think let's talk to some of the big issues first. What you think will be driving the stock market in coming months?
Well, in coming months, definitely what the Federal Reserve going to do.
Yeah.
We have the FOMC meeting this week. If Federal Reserve decided to cut rate, which the market want, then I think that will spark another round of easing around the world. So that will be one of the things to look at.
Good for stocks?
It will be good for stocks because in comparison, the equity yield will be far better than the bond yield.
Yep.
Vice versa, what happens is, if the Federal Reserve decided to hold rate, that will send a short wave to the market, and we may see, a bit of a breather for the market. That will be a good time to pick up some good stocks.
A buying opportunity you're sort of suggesting,
That's
aren't
it.
you? Yeah. Okay, so therefore your overall feeling about stocks, maybe over 6 months, even a year, still more confident than negative?
I think so, because when we look at the earnings, earnings is there. The earnings yet to go backward. In fact, for the last financial year, the 1819 financial year, market pretty much look for a flat earnings. So
Are we
it's not
talking
going
the US
down.
market here?
We talk about the Aussie market.
Aussie market, flat?
Yeah.
Yeah.
So that will have a major implication to our August reporting season because in August, the market is going to report on, the company is going to report on what happened last year. So we think the hurdle will be pretty easy for many companies to meet. The question I do want to focus on will be this financial year, 1920.
Looking forward.
Looking forward, because the market at this stage is looking for 9% earning growth. So the question is, where do we see this 9% earning growth? It would either be, the rate, the interest rate in Australia are low enough to stimulate the consumption, or the general recovery in the property market, and also it could be, the China may not be going soft as most people believe. So there's a number of factors.
And we've got tax cuts and the minimum wage cut as well. All those things are going to help, aren't they?
Yep, that will be.
And rate cuts, of course. All right, Raymond, let's cut down to business. People always want to know what a 24/7 stock man like you like. So let's go. I'll ask you to go for 5 stocks. Just kick off your first one.
The first one, I think, Westpac, will be the first one come to my mind.
Why?
First of all, Westpac is one of the major bank, and we think the risk profile for Westpac actually lower than the other major bank. The reason I say that is because they have a lower reliance on the income coming out from the market income. So they make most of the money from net interest margin, which is more
traditional banking.
Which is more calculative, more measure. But as we can see, Westpac tend to trailing other banks. One of the concern with Westpac is they have probably a bit bigger portion of the loan book in interest-only loan. So with bigger interest-only loan, people generally believe they are more risky. However, since early 2017, Westpac already cut down the portion of the interest-only loan from something like 50% to today, just 30%. So we think the risk profile has improved. As such, I think at around over 6% dividend yield, fully franked, is a good one.
So 6% before franking, so we're talking 7.5% for anyone in the tax-free zone. Even more. Okay, that's the first one, Westpac. Let's go to number 2.
The second one is, it's not really that typical, but Aussie Mineral come to my mind.
Aussie Mineral.
Yeah. So I usually don't like single commodity stocks. Obviously, Aussie Mineral is a copper play. They do they have a bit of gold as a byproduct, but mostly it's a copper play. However, we like the management team in the sense they manage to steering through the company during good time and bad time. And with Aussie Mineral, we have to remember they are a producing company. So they got two producing mines. One is in South Australia, the other one is in Brazil. But what happened is, they got pretty good margin and they have a net cash in the balance sheet. So in case, if things got tough, they'd be able to survive better.
And I guess if a global recovery kicks in 2020, 21, miners are going to be a beneficiary.
Exactly. Also, they're in the process of ramping up these, new development also in South Australia. So this big mine, they are now in the final phase of building up. So they're now building what they call a above ground infrastructure. So once that's built up, they can start doing the production. This is where the risk coming from. Always risk in the ramp up. However, if things gone well, I think there will be some uplift potential.
Right, number three.
Number three, Westpac come to my mind. Sleeping apnea is a big problem in the world. The biggest, market in the world is US. In US, we think there will be around 12 million people got this problem. As of today, only 4 million got treated or diagnosed. Westpac is operating in such a big market. And the most recent quarterly, results suggest, they are actually getting more business.
Market shares increasing.
Yep. At the same time, they're not sacrificing the margin. So with Westpac, yes, they're a bit pricey at the moment, but always look for quarterly result. Any disappointment come at a quarterly result may be a good buying opportunity.
Okay, good.
Yep.
Let's go your fourth one then.
The fourth one, you're pushing on it, Peter.
Yeah.
Well, I would say Telstra will be the fourth one I like. Well, Telstra, after 4 long years of underperformance, we start to see a bit of turnaround in the share price. For one, I like the fact that people no longer think about Telstra as a yield stocks because obviously the board has revised down the dividend strategies. People actually look at the fundamentals. So the fundamentals now is all about 5G. With the delay in Optus, TPG, Vodafone in building up the 5G network on the back of the Huawei issue, we think Telstra will have the first mover advantage. The other thing, the market started warming into Telstra. A big part of Telstra business is actually infrastructure assets. If we price on that basis, it should value higher.
Yeah, and what's the dividend yield nowadays? I know it's less than it was, but still okay, isn't it?
It's still okay. To 4 to 5%. It's not going to make you really, really rich. However, I would rather to see Telstra on a sustainable dividend yield. And when the rest of the business kick in, such as the 5G business kicking in, that will be very important for the future. Okay,
final, number 5.
The last one, I would have to say Origin. Origin Energy, back to the old day, it was spin-off from Borrow, and then it is up and down. At one stage, they basically invest a lot of money, actually too much money, into the APLNG, which is a massive infrastructure and resources base. They own 37% of it. The good news is all the investment has now completed. They start to get cash flow out of that. So once they get a cash flow,
the worst is behind in that respect?
I think so. Last financial year alone, if my memory serves me right, they got about $800 billion cash distribution for their ownership. So this year, I think they will got similar or more from that. The beauty about it, they be able to cash flow, will be able to pay down their debt and increase the dividend payout, because with Origin, they have suspended dividend for a few years. They only
resume. It used to be a good dividend payer, wasn't it?
Exactly. So they, they suspend the dividend. They only start paying dividend this year, a little one. However, the next one could have a potential to be a little bit higher. The risk for Origin, of course, is the electricity price, because another part of their business is retail, energy retailer. So it all depends on the cost of the electricity.
Yeah, and it's a very competitive market nowadays,
Exactly.
isn't it?
Yep.
Raymond Chan from Morgans, thanks for joining us on the program.
Thank you, Peter.
That's Raymond Chan, as I said, from Morgans, and he's a guy who I certainly respect his point of view because he does a lot of research before he opens his mouth. Glenn Keys is the co-founder of Aspen Medical, which has been an Exporter of the Year award winner, a Telstra Business Award winner as well, while Glenn has been the ACT's Australian of the Year, and he was EY's Entrepreneur of the Year in 2016 with his colleague Dr. Andrew Walker, and he's the ACT Chair for the Special Olympics. Glenn is a very special Australian and an inspiration we all could learn from. Now, the reason why I want to talk to you is that okay, you're a businessman and you're ex-military, but you've got some fantastic stories of where your business, Aspen Medical,
Yep.
Right, how it's got involved in some of the biggest troubled hotspots in the world. Give us two stories that people will understand what your business does and can do.
So we go back to early on in our business. We were engaged by the Australian government to go into Timor to provide all of the support while they stabilised the country. And while we were there, there was an attempted assassination on Ramos Horta, the president. He took 3 high-powered bullets to the back. He was brought into our theatre. As you could imagine, he was a mess. We operated on him for 6 hours, removed all 3 bullets, did a liver resection, and we had a thing called a walking blood bank, which all of the Australian soldiers were part of. And we put 12 units of Australian soldiers' blood through him, flew him back to Darwin, and then our ambulance took him round to Royal Darwin Hospital. And when he came back to Timor, he presented the Timor Solidarity Medal to all of our staff, the only civilians to ever be awarded it. And then the other one I think that's particularly impactful is when the Australian government engaged us to be the Ebola response on behalf of the Australian people. And part of the reason for that is that we'd already been contracted by the US government to run 4 Ebola hospitals for them in Liberia. So we did 4 in Liberia, the one for Australia, and then we took over 2 of the British hospitals. So at our peak, we were running 7 Ebola treatment hospitals across 2 countries, 200 expats, 800 Africans operating across all of those, not one single infection in any of our staff. And hundreds of people saved.
Now, I know you said to me before this interview, I really appreciate that I've given you the questions, but as you know, I never ask the questions.
No,
anyway.
I'm guessing this is just we're just gonna wing it as we go.
Well, the thing is I always like to think what people are thinking after I hear your fantastic answers. And my question is, how can governments get a private organisation to do it? You would have thought that with the military and all the other emergency services, a government could do it. Why is a private organisation like you doing this sort of stuff?
Look, part of the reason is that government nowadays can't afford every single capacity and every single asset for every single scenario. So the Australian Defence Force has an incredible capability, far more capable than ours. But is it the right people to be sending to the other side of the world? You know, Sierra Leone was, literally the furthest country in the world away from Australia. Are they the right people to be sending? No, they're not, because we need them for areas. AUSMAT, again, an incredible Australian capability. We need them because it was November, coming up into cyclone season for the region. And so you've got to have horses for courses. We help fill those gaps where you can't have every capability for every single incident.
Okay, let's also, I'm sure somewhere in my list of questions this would be here. As a consequence of you deciding to get into this space as a businessman, you have actually created a pretty big business. Give us some details about how big this business of yours is and some of the awards you've picked up along the way.
So look, we're currently tracking at about 2,000 staff in 16 countries around the world. By the end of this year, we'll be 3,000 staff because we've got a major public-private partnership going off in Fiji, which is really exciting. I was actually at a talk at the ANU Crawford Leadership Discussion this morning talking about it. And we're delivering everything from supporting Defence Forces to humanitarian care to providing health professionals into remote Indigenous communities across Australia, to supporting the resource sector around the world, and to clearing public surgery waiting lists. Some of the most recent awards, we're currently the Australian Exporter of the Year. And 2 years ago, my business partner and I were nominated as the Australian Entrepreneurs of the Year, and we went to Monte Carlo for the World Entrepreneurs of the Year, and we were the runners-up. So we've had some amazing successes, but honestly, all off the back of the amazing work that our team do wherever they are in the world.
Okay, next obvious question, which I'm sure is on this list as well, is how did you go from, because you were military first, and how that came Aspen Medical?
No, I was, went straight from school. My birthday's on the 30th of June, so I'd skipped a year early.
Yeah, okay.
So I went to the military. I was there for 15 years. My wife and I had a son with Down syndrome.
Right.
Who's a fantastic kid, but we realised that to give him the support he needed, we needed to be in one environment, not being posted around. So we got out. I helped set up a startup from there for about 4 or 5 years, which was very successful, grew to about 80 people in 3 cities. We then sold it to a major US defence company. I was there for about 4 years, learnt an enormous amount, a great environment, but also realised 2 things. I probably was not a multinational sort of guy, and I probably wanted to do something that had more of a social purpose to it.
Yep.
And so Andrew, who I went through school with, who is a doctor, and myself, we founded Aspen Medical back in 2003, and we've just grown it solidly since then.
Hey, you've won Telstra awards as well, haven't you?
Oh, we've won a huge number of awards. We've won, back when BRW used to print, that's how long ago,
yes.
Fastest growing company in Australia. We've won awards. We won the World Project Management Awards for our work with Ebola. We've won Telstra awards, and we've been the Entrepreneurs of the Year. So just a huge number of recognitions.
Okay. What is your competitive advantage? Okay, I understand you've made the point that the Defence Force and other related government bodies can't do this. But what do you think is, apart from your individual brilliance, Glenn, it's the reason why I'm talking to you now, and that's why my audience is watching you as well. But what do you think is the critical competitive advantage?
I think we understand risk and we know how to deliver incredibly well. So if you can imagine a little Venn diagram of operational delivery, project delivery, and risk management, and you overlay those 3, that little sweet spot is where we exist. Because we don't do every single job that comes to us. Because some of them we do the risk analysis on and we say that just can't be delivered. But there are others where other people have no idea how to deliver it. The quality of people we have, the standards they operate to, the risk mitigation strategies we put in place mean that we deliver on all of those projects that we accept.
In the past, were there businesses like yours that do this, or is your business something new of the internet age, the technological age, and so on?
So really, we were kicking off without an enormous engagement in technology. We were using it to communicate because we had people around the world and we were transmitting. And to be honest, a lot of the technology that's really kicking into healthcare isn't of a robust nature that's going to be able to operate in the middle of the jungle or the middle of the desert. Right, it wasn't then. And of course, the other thing is a lot of ours is project-based. So it's very hard to bring in high-end technology if you're trying to amortise it over the life of a project. What we are starting to see is as that technology gets more and more robust and the price of that comes down, that we're now looking at more and more technology we can take into the field. So telehealth is a classic. How we can take telehealth, not just to be able to have a doctor view a patient, but to be able to measure them remotely, to look inside them, to take temperatures, read ECGs, transmit that back to people. That's becoming so much more robust. It can go out of the surgical theatre and out into the bush. So I predict that, while the care that's currently being provided to, say, really remote areas for the last 20 years has varied little, bit of telehealth coming in, I think the change in the next 20 years will be dramatic. When you overlay that reduced cost of technology, more robustness, and then bring in increased access to AI and what we can do with patient data, I think we're really going to see massive changes in the next 10 to 20 years.
Right. You're currently, I would call huge, 3,000 is a lot of people to manage. Did your background in the military help you cope with the growth of the business and the management of people, or have you made a lot of mistakes along the way, you just got better at it?
I think that both of those are exactly right. So, of course you make mistakes, but the military is actually very, very good at teaching you to manage people, to make the best out of people, to work out what they're strong in and move them into those areas. It also teaches you to be pretty self-aware and look at what you're not good at and what you need to improve in. And we've got some pretty strong-willed people, as you can imagine, and they're not backward in coming forward to tell me if they've made a mistake.
Yeah.
And so to be able to listen to them, hear that, and work out how to take it forward is pretty critical too.
Was there one book that you've read that really made a big difference to the way you ran Aspen Medical?
I think there's a number of books. One of the ones that was most critical was right at the start, before I even kicked off, which was a book by the Dalai Lama, which was, he tells the story about where he went to some of the concentration camps in Germany. And the bricks are all handmade, and the brickmaker puts their thumbprint in each brick as he made it, because he was so proud of the quality of the bricks. It was his signature. And the Dalai Lama said, do you think that he realised that as he was so proud making those bricks, and yet they would make gas chambers and kilns to kill people? Did they understand that? And it really struck me. And it made me think that the things we do, the impact it has into lives, the impact that it has, I consider myself, I've just won the lottery 12 times over. I'm white, male, English speaking, well educated, with my health, brought up in a happy family, living in a happy family, with all the things I need, living in one of the best countries in the world. If I didn't give something back for all of that, I deserve a bit of a slapping. And so that book, combined with that understanding of how lucky I am, made me realise that, yes, we want to have a business, we want it to be profitable, we want it to achieve, but we also want to make sure that we can deliver on a social purpose that will motivate our staff and our customers and ourselves.
Okay. Someone starting out in business, Glenn, what advice would you give them?
Whatever it is you're going to do, be so passionate about it. Just so passionate. So that if you're up at midnight, 2, 4 in the morning, writing a proposal, hole punching to get steps in, if you're working with your customers, if you're busting your butt on the weekend to make it work, you don't mind because you love it. If you're not love it, if you're not engaged and passionate, and you can't sell that passion to every other staff member and customer you've got, then you're in the wrong job.
What about looking for experts to help you out where you're weak? Has that been important to you?
Oh, absolutely. There's no way in the world that I know all the things I need to know. I think there's a few things I do well, but boy, oh boy, it's a pretty short list compared to all the ones I don't. And finding other people to help you and ask them and listen to them and work out what you need to improve on, absolutely fundamental for any business.
Okay, last question. Was there a question I really should have asked that was on this list that I haven't asked but you'd like to share with my audience?
Probably the one thing is what we're doing right now. So we've just finished a major job with the World Health Organization in Mosul. We operated for 15 months in Iraq.
Iraq, okay.
Iraq. As part of, you remember there was the war in Mosul and they were driving IS out. We ran trauma and maternity hospitals right up very, very close to the fighting zone. We treated 48,000 casualties through the trauma hospital and we delivered 3,000 babies in that time. And we handed those hospitals back fully operational to the Iraqi Ministry of Health. And most recently, we've just signed a contract, PPP, with the government of Fiji to take over 2 hospitals, one of which is Lautoka, the second largest hospital in the country. The other is Bar. And by the time we finish taking those over and running them, which will be at the end of this year, we'll be caring for 25% of the population of Fiji on a 23-year PPP, rebuilding that Lautoka hospital. And Lautoka and Bar will be the only internationally certified hospitals in the whole of the Pacific nations.
I have to ask this question. You're so close to trouble spots, and they are dangerous trouble spots. Have you lost staff as a consequence? And if so, how do you manage that?
Look, we haven't. So, I bless every morning that I wake up. I do think a big part of it is that we do a lot of risk analysis before we go in, that I mentioned before, but we have a very, very strong project management team on the ground. They're always thinking about security, they're looking at our logistics, and our safety of our staff is always paramount. There was a job we won a few years ago that I spent 2 years winning and not an insignificant amount of money. When we went in to do the site survey, we had heard that the prime contractor had lost over 50 staff members that year. So like one a week. And we just said, we're not prepared to do a business that will put our staff at that sort of risk.
Glenn Keys, thanks for joining us.
Oh, it's wonderful. Thank you very much.
Pleasure. Glenn Keys, one of the extraordinary Australians who have created an extraordinary business. Hi, I'm Peter Switzer.
And I'm Paul Rickard, and we'd like to invite you to our 2019 Switzer Listed Investment Conference.
Now, the Switzer Listed Investment Conference brings together some of Australia's best money managers. On the day, they'll tell you how they're investing both at home and abroad and give you tips on how you can maximise your investment portfolio. Tickets are only $49 and available to purchase now. Don't miss out on your opportunity to hear from Australia's best money managers by securing your spot now. For more info and to purchase tickets to the event, head to www.switzerevents.com.au. Attending will help you make well-informed financial decisions this year and maximise your portfolio. And now it's time to get inside the head of two of Australia's best market thinkers, Aitken Investment Management's Charlie Aitken and the Switzer Report's Paul Rickard, who was the founding CEO of Comsec, so we should know a thing or two about stocks. But we won't question him about that particular issue. Charlie, what we saw the market was down today, and what I think I'd like to get from you two guys today is, what's the strategy for investing going forward, and why was the market down too?
Well, I think the strategy for the rest of the year and probably the rest of the next few years is to buy any significant dip, buy the best companies you can, and stay invested. I think you get little dips like this on slight changes on interest rate expectations around the Federal Reserve.
Yeah.
You get the
Why
odd moment where the good payrolls number in America on Friday.
Huge, wasn't it?
But it drove the bond yields up a little bit. It drove interest rate expectations a little bit off their highs. And when a market that's just bid up anything defensive or anything with a yield, it was just a day off, really. I mean, Transurban and some of these Australian stocks are back to the way they were 3 days ago. Yeah. So look, I'm still pretty constructive on markets. I think interest rates are going to stay very low, and I still think you can find companies with good earnings growth at reasonable prices. Yeah.
Paul, is this a sign that we should be waiting for a bit of a sell-off?
Look, I'm not sure it's a sell-off just yet, Peter, but I think people need to be patient in this market. I think that one thing the last decade has taught us is patience. And you never have too much of it. And the market is not suddenly going to just race away. Look, obviously a little bit of a change of assessment in the States, but locally we're just playing follow the leader. And I think we might see a bit more reassessment in the US because bond rates just don't go down all the way like that without coming up, and nor do equity markets go the other direction all the way. So I think just be a bit patient. The market's had a big rally on really, just expectations about interest rates. So you get a slight little blip up at interest rates in the US. Well, it's not surprising the market's just going to pause.
The interesting thing coming up is, like Australia, I'm more cautious on. I think Australia is ahead of itself in terms of where it's got to. I can't really.
On company profit.
Correct. I think that the Australian economy is not as great as the share market, quite frankly, and I think the August reporting season could be a little bit iffy. But the American reporting season that starts about midway through this month should be pretty good. Most of those tech companies, nothing much has changed for Microsoft and people, I'd suspect. And I think that the American earnings setup's pretty good. So I still think that there's not much of an alternative to equities. I mean, but the dips, you got a good dip in May that was worth buying. You might get a bit of a dip in the next few days. But as Paul said, just wait for your moments. Just wait for your moments.
Okay, so Paul, if you're waiting for the moments, what kind of stocks are you hoping to see the price come off the boil so you can get in and buy more of?
Well, I still, believe it or not, Peter, still like banks. I'm probably the only person in Australia who tells me they're overbought. I think the whole market is a bit overbought, particularly a lot of defensive stocks. So, look, Transurban at $15.13, I think it closed today. It's still probably $1.50 more than it should be. It gets back to $13, I'll probably be looking at it. But so the defensive stocks, I'm not in those. I think they've already had their go, but that doesn't mean they won't. I guess in a dip down, they're worth looking at. I think you've got to look for some of the cyclicals potentially, but it's still, the market is out of love with a lot of these stocks, and it's going to take some good numbers to reassess it. So if I had to say the one sector I think is probably risk, value for money in a risk sense is probably still financials, but I'm not there with the rest of the market on that one.
Charlie?
Oh, it's interesting. As you know, I've really my lightest exposure in Australia in a very long time. The only thing I've been buying is actually A2 Milk, because I think I'm trying to find any company that might beat earnings expectations organically in the coming reporting season. I think A2 Milk can do that, probably by maybe 5%. It needs to because it's a reasonably expensive stock. But there's so few stocks I can find in Australia that I think will beat the consensus expectation coming up in August.
Do you worry about the Chinese regulations? and
Not
how they
really.
affect
I think
like
that's why
that?
the shares went to $13 the other day. I think the Chinese have always a risk of regulating parts of the infant formula sector, but I think that's an opportunity for A2. I just think if I'm looking up in the next few weeks of where I can see some earnings growth or some earnings beats, it's a very short list in Australia. So the only thing I've been adding to in Australia is actually A2 milk.
Okay, Paul, you and I on Switzer TV looked at the various components of the ASX 200 index, and the small orders really struggle compared to the top 20.
Yeah, the
Is
market,
that where we should be looking
the
at?
market is still being led by the top 20. It's a combination of two things. It's a combination of what's going on with iron ore, which is really driving BHP and the Rios. It's a combination of the banks have done okay. The defensives like Woolworths and Westpac to some extent are all super pricey. And Telstra, has performed off such a low base. So, and people have been have steered clear of the cyclical stocks that tend to dominate that sort of 100 to 300 part of the market. Now, a brave investor would look back in there because there are some real bargains.
There's some value in there.
But you've got to find them carefully, and I think the market is at the moment it's not playing that game. So whether it'll come back to that, Peter, I'm just not there at the moment. At the moment, it's sort of, it's resources for and gold for interest rates. It's some of the IT companies. And it's some of the defensives. And I guess it's got to shift back there. Maybe we already got to see some good earnings numbers, I think, to drive some of that.
I think the other thing that's going on, Peter, is this massive structural change towards index investing. I mean, 50% of the market's now passive investments, and obviously passive investments go index weighted to the biggest stocks.
Yeah.
So you find the market that those large stocks are getting a disproportionate amount of inflows. When money flows into equities, half of it is going into passive products, which pretty much means half of it goes into the largest stocks. It's exactly what's happened in Wall Street as well. Apple's led the rebound, the biggest stock. So you've got to always take into mind, which obviously the same works in reverse.
Yeah.
The market goes down, the big stocks will lead it because of money flowing out of index funds, but it's just a new dynamic.
And the data, Peter, is showing that activity is up. Now, that does tell you that they're net buyers. The ASX is reporting higher cash number of transactions.
Can you believe ASX shares are $87?
Yeah.
I can't. I absolutely can't.
I got out of ASX at $58.
I can't believe
they're
that.
overvalued at $58, and they're now.
I just can't believe it.
higher. So
Well, I guess when they haven't got a real rival, it is easy.
Yeah, but I mean, it just, that one actually stuns me where it's got to.
I mean, I guess at least one thing that has got going for it is that there has been an increase in activity, right?
Yeah, sure,
and that's the bull market coming through. So I just go back to your point, Peter. I think you've got to look at the market, and I agree with Charlie. It's sort of it's a really bizarre market now. It's a bit of a sell-off. I think you reassess and you start to look more positively about it.
Okay, one last thing. I wrote to Doug after our webinar last week. One of the viewers asked us whether BHP they should sell right now. And I looked at the analysis, and all the analysts really believe it can go higher, which I thought was quite surprising. But they do. They all think it can go higher. But then you had the Chinese steel mill owners complaining about why is iron ore prices so high? And for 2 days, BHP's gone down. Is this something you would buy on a dip, Charlie?
Well, I'll tell you what I'd do. I think I'd be if I was worried about resource stocks right now, I'd be worried about the pure play iron ore stocks. I mean, I think the iron ore price you see in front of you is utterly unsustainable. And even if it's Chinese intervention or more supply or Vale coming back on, something will bring that down. People are digging it out of the ground for $15 and selling it for 114.
Yeah.
That's not going to last.
Yeah.
And so I'd be more cautious on Rio and Fortescue and Mineral Resources and the pure plays in iron ore.
Yeah.
And I think BHP is far more diversified, only 25% of its earnings are iron ore. So I'd be more tempted actually right now to take some money out of the pure play iron ore stocks and maybe buy some BHP on a dip. But BHP is actually the last one I'd sell because it's the most diversified.
Paul?
Look, yeah, but Peter, all along I've said, look, it's time to lighten off. I prefer BHP because it's more diversified. I think who knows where this iron ore price is going. All I know is the analysts and nobody can tell you where the iron ore price is going, right? Yeah. And the Chinese government's the latest people to try to influence. And maybe they could do...
They can probably do a bit more than analysts can to it, I'll tell you.
Look, stay with the trend, but it's time to lighten off. The stock, I think, is way overvalued as Woolworths, Peter. It does show you how defensive it is. It's trading at a multiple of 26 times this year's earnings and 24 times next year's earnings. Yeah. This is a low-growth company in a tough competitive environment, right? That shows you how the market is... has really priced some of these stocks.
But it's gone pure, Paul. It's gone pure. No
sure,
more gambling.
It's still got
Haven't we all?
It needs to go pure, Peter, but it's still got big W to get rid of. But look, I mean, you've got to be a little bit courageous in this market. That's why I come back to, I know it's out of favour. I just think, Vera tells me the banks have got no future.
What bank?
We'll still stick with the CBA, and ANZ's probably the best on the cost side. So, but they're the cheapest stocks in the market. They're not overbought compared to a lot of other stocks.
I
out
guess
there.
if you get it wrong, you
But
still get a
everyone tells
dividend.
me there's no earnings growth. I agree there's no earnings growth, but there's not much earnings growth in a company like Woolworths trading on 24 to 26.
Yeah, I'd rather pay for no earnings growth knowing I'm getting no earnings growth than paying for no earnings growth and paying 27 times.
Yeah.
Okay.
Yeah.
Good point. Charlie Aitken, Paul Rickard, thanks for joining us.